Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the markets closely related. And it's another fun week to give you sort of a retrospection, and then we'll do our best to give you a little look ahead at what we see playing out here in the coming days or weeks, especially as we enter into the summer. And the volatility has calmed down just a little bit, not a whole lot of price difference. I mean, we're recording at 1,965, so after last week's big drop, not a whole lot of movement here. Miles, you ready to jump right into the gold chart?
Yeah, let's do that. Anybody that was with us last week knows we had a pretty long conversation just about debt ceiling related discussion. So we will have a little follow-up on that here at the end of the show today. Quickly jumping into the metals, you're correct. Gold came down. We had a nice little 50% retracement happen in the price of gold, just going back to the beginning of March where we started, and then finishing out the high point right at the beginning of May with that brand new tiny little all-time pinprick high on the futures market. So we did retrace back down about halfway. I'm looking at the spot price here on my chart, so it doesn't line up with that 2085 futures, but very relative. Similar looking chart. So what happens now? You know, we've had a couple bounces in between the 50% and the 382 line. We're right back up to the 382 as we're recording. In fact, we pushed above it earlier today, but it looks to be settling back down below. So I think there's a couple things that could happen here. When you're in a trend, even a short-term trend, and we are still in a short-term pullback trend, you know, we had a significant rise. Now we're having a little bit of a blow-off before we probably start our next rise. So there's a couple things that could happen here that hint at potentially lower gold prices. So there's a few things I think people should be aware of. First, we could just keep going down to the 618. One of my big calls here a couple weeks ago is I think low 1900s is a very reasonable target. Well, we've been between about 1940 and where are we at today, 1970?
1965 right now.
Okay. So we've definitely been in between a couple really nice levels here, really clean looking between the fib levels. And we could just continue to trail off to maybe 1910-ish, somewhere in the low 1900s, and then turn around from there. So that's certainly one option. I think that would provide a phenomenal opportunity for those of us that are dollar cost averaging into gold. There's a second thing we could see happen. Actually, one of our fellow advisors here, Shayla, brought this up to me, and we were talking about it this morning. We had this channel in gold as we were coming into the top end between like March and May, where we were building this channel. We broke down below it. That kind of signaled that we were probably going to be taking a pullback. Well, we could see gold continue to rise here for the next couple weeks and go up and touch that channel, and then turn around and scare a lot of people, come right back down to where we're at now, but even start building a base from there. So we actually technically could have seen a turnaround point here in gold a week or two ago.
Right around that 1940
Exactly.
level. Okay.
And we may not see my 1905, 1910 number. That very likely couldn't happen. If we see gold continue to push up, it would probably be a pretty strong ceiling that we'd have a pretty big deflection back down off of. But there's a good chance that long term that's telling us gold's going higher. So there's a couple different ways I could see gold coming back down. One would be we just keep going down from here, maybe to the next correction level. Eventually it's going to find bottom and turn around. And these are the types of things I think it's important clients pay attention to, is we could see a lot of volatility over the next couple weeks, especially with some of the other debt ceiling discussion, with interest rate discussion. Gold could go up $100 and then back down $100.
Yeah, I'm really hoping for the latter. I mean, what I hear you saying is gold could go up or gold could go down. That's really stepping out there, Miles. No, I'm just kidding.
Thanks.
But
you
no,
know me, I really like to take a hard line when I'm predicting the future.
I really want the pullback, and I'm still optimistic that we come down into the low 1900s. You've got the summer woes, if you will, too, the summer doldrums that gold oftentimes experiences. So don't be surprised if we hit a low for the year in June or even into July before we really take off and run again. Am I very bullish about the price? Yes, I'm very bullish about the prices for the next couple of years. And the debt ceiling is going to be one near-term indicator, as will interest rate hikes. And we'll get into some of those fundamentals because I know that you believe that it's the news that changes the pace at which we reach these figures. But you can't predict the order of the news, and you can't certainly not predict the date that you'll end up seeing those prices.
Right. And where I think I probably am still siding with you on the idea that I think gold could slip a little bit further is when you zoom the chart out and you actually look at the whole bull market, or not, well, the whole bull market started in 2016. So let's just say since November, this last actual move up, I mean, we're just barely scraping the surface in a pullback. It could be quite a bit deeper from here. You're talking a $400 move in like 4 months.
And yet a very healthy pullback.
Yeah.
Right. So
even lower than where we're at now.
That's right.
So I agree. I think it's completely reasonable we could see something come a little bit lower. I just wanted to see a couple examples since we are kind of at least a short-term level today while we're recording.
What about silver? Again, we'll get into the fundamentals in a bit here after the charts.
So silver did similar action, except, again, we've talked about the concept of leading the charge. Sometimes gold seems to be leading the other metals, and then silver follows, platinum follows a few months later. I think there's a reasonable argument here that silver might be leading out in that when you look at its short-term move. Now, this isn't unreasonable. Silver is a more volatile metal. So it's not unreasonable, but silver has come back to its 618 fib, had a really nice touch down around 22.5. We've bounced back up. We're back above the 50% line. Your real next stopping point is maybe around $24. But if we get above $24, there's really nothing stopping silver all the way up to 26, 27. So it's very possible. While we haven't really gotten the signal yet that we're looking at a breakout on silver, it's really possible we could have gone from 26 to 23 back to 26 in a very short period of time.
Yeah, our previous expectation was really that $27 to $27.50 mark. And
right, which we just came short of.
Yeah, we were still short of that. I'm still hopeful that we will see that. Again, we just don't know which happens first. And that silver volatility is beneficial from a ratio standpoint. The ratio's back up to almost 84 to 1, coming off of the really 76 is where we ended up bottoming out for a brief period of time. But that's indicative of a 14% pullback in silver compared to just a 7% pullback in gold. So there's your recent volatility. But likewise, on the way up, it'll double gold's performance and take that ratio right back down below the 80 mark.
Sure. So let's take a look at the other white metals real quick, because I think platinum is having an interesting reaction compared to, say, both gold and silver. We're having a pretty nice week, having a little bit of a bounce this week. Platinum just fell off the table, just decided to drop from the 50% line to the 618 fib just, a day or two. So pretty significant decline in platinum, and palladium is sitting at 5-year lows.
Yeah, that's also a really powerful ratio that we watch. It's one of the most effective at compounding ounces, but it's almost like platinum just has a 2-week delay. It's like it forgot to follow silver a couple of weeks ago, and it's just now playing a little bit of a catch-up once silver has stabilized. So I'm not down on platinum. It's been very actually stable and encouraging to me, and you're always one geopolitical event away from that being the trade of the year.
Well, and I overheard Kevin, I don't know if it was on the commentary, I think it was just an office discussion, but I know there is some concern out there about platinum availability is finally starting to rear its ugly head. I mean, with sanctions on Russia and obviously political unfortunate situations elsewhere, the supply of platinum is pretty bottlenecked from a couple places.
Exactly. Without those dynamics, we're still slated to have a 1 million ounce shortage, like we talked about on the show last week. That the expectation is for a demand of about 8.3 million ounces and an expected mining of 7.3. So just that alone should serve well for the platinum investor.
So platinum continues to be pretty interesting to me. Also, anybody who got into platinum, say a few years ago when we were bottomed out on it, and the ratio between platinum and palladium has already gone from about 0.3 to 0.75.
Yes.
So even though I don't think we're anywhere near where we're going, platinum investors have already doubled their palladium position at this point, with, I think, a long way to go from here.
That's right.
So turning the tables over to the not commodities market, although I know there's some in there, but taking a look at the paper markets, the Dow, I don't really know what to say that I haven't been saying for months. I mean, we can't put in a higher high. We keep having these landslide declines. I don't know if the Dow's really going to drop off the table, but I also can't imagine that at now under 33,000 again, at 32.9, I don't see us going to 34 or 35. I see us going to 30. Like, I think we're looking at another 4,000 or 5,000 point decline, and I think we're getting back to where we were last year. Don't know where else to put money right now.
No, I'm with you. And economically speaking, there's every indication that the Dow should be rolling over. And if it weren't for AI and the tech stocks, that are in a frenzy right now, the NASDAQ and S&P would be following suit.
Sure.
So I'm with you. I'm scared of the stock market, out of the equities, and, far better to be sitting in cash alongside your precious metals position and maybe some yield in your treasuries than it is for you to be chasing return right now. There's danger in the waters.
Right. Well, speaking of sitting in cash, the dollar is rising. I mentioned that it looks like the dollar might be building a channel between about 101 and 106. We came down and hit 101 for the second time. We're now on our way back up to 106, which was kind of a breakout level to the downside when you go back to November of last year, November, December. And then we came up and touched it again back in March. So the dollar is climbing. I don't know if it'll push much higher than that. Certainly raising interest rates is supposed to help with that, although it seems to be losing its benefit each time we do it, which is not surprising. You can only pump so much nitrous into the gas tank over a short period of time.
Well, and it all depends, too, on what other central banks are doing. So what other central banks are doing is they are buying gold at record paces still. Right. And far as the dollar strength on the dollar index, if they're raising rates, then it all becomes a relative. But to me, this fascinating chart that you started creating many months ago is continuing to play out, where there's this complete opposite movement, where they're moving counter to each other, the dollar and the price of gold. And this is a fun chart that we're going to show here.
Yeah, the Rorschach ink blot chart of gold and the dollar, where you kind of see this like perfect mirror image of action between the two markets.
Yeah, so we talk about gold reacting, right? It reacts to geopolitics. It reacts to economic news. It reacts to monetary policy and fiscal policy in Washington. But it also reacts to the strength of the currency against which it's being measured. Well, this is a perfect example. If you want to predict where the gold price is going, then predict where the dollar's going first. And so if we do see summer lows, that means that the dollar rally is going to continue here. Well, what's going to cause that dollar rally to continue? It's going to be strong dollar policy. So if they do raise rates again, the Fed lending rate here in June, that went from a 0% chance to now about a 60% chance that the whole market had priced in the fact that they weren't going to raise rates in June, that they would pause. But not since the core PCE came out. That PCE is the personal consumption expenditure, and that's the primary indicator that the Fed likes to use to track inflation. Well, it was up 0.4% in April, and 0.3% was expected. That's 4.7% annually, and it strips out energy and food, so that's kind of a key piece. But what we also saw, two other key points with inflation. Personal spending was up 0.8% in April, and personal income was up 0.4%. And why is that significant? It doesn't sound huge, but that's 10% a year and 5% a year. Why is that important? Because they're trying to drive spending down, and it's still going up. They're trying to drive personal income down, like wage repression, and it's still up. So what it's telling the Fed is that their policies are not having the full effect yet. And to me, they're going to have to raise rates. So that could cause a dollar rally. Like you said, though, lately the dollar has actually been responding opposite of what you would expect. The last 2 to 3 rate hikes, we've seen the dollar go down and gold go up. I think it's just so much uncertainty that gold is just climbing in price.
Yeah, and I mean, obviously a lot of that would have had to do with the initial kind of shock reaction to learning that we're going to be in a rising interest rate environment for a period of time. So you always assume there's going to be some kind of panic move followed by a deep breath sigh. And we've seen the deep breath sigh. The dollar index going from, where'd we top out? Like 110?
Almost 116.
115, 16, back down to 101. Now is the dollar going to plane out and find a balance in value? Are we going to have a stable dollar at 104 for the next 5 years? I mean, I don't think so. There's a really easy way they could fix the other problem you just mentioned. They've already taken food and energy expenses out of the measure. They could just start pulling other things out of it too.
Sure. Well, yeah. And the dollar's not just going to respond to rate hikes. The dollar's going to respond also to certainly this debt ceiling discussion. So we went into some depth. We're not going to beat it up here today, but as fiscal policy affects monetary policy and that sort of thing. This debt deal that is on the table now that Congress will be debating next week doesn't change anything. In fact, all it does is assure a normalization of that post-COVID spending spree that we saw. It's almost like it raised the bar and it becomes the new floor, much like one of these charts. That ceiling is going to become the new floor.
Right.
And they're slated to have an increase of 1% per year with very few budget tightening expectations. Keep in mind here, there's no debt limit actually being set. They're talking about just suspending it entirely until January 2nd of 2025, which conveniently is right after the next round of elections.
Yeah.
That's telling you that they're going to just write blank checks left and right. And in fact, they do have this pay-as-you-go type of authority, and it gives them authority to spend if, quote, it's necessary for program delivery, unquote. So who knows where our debt's going to be? We're going to add a minimum of 2, some say 6 trillion, depending on the response, in that period of time. And yet McCarthy's happy. He's saying, we let government grow with this deal, but at a slower rate. Well, no, government's still growing. That means debt is still increasing. This is why you buy gold, right? It's guaranteed theft, the depreciation of the purchasing power of the dollar. The more money in the system, the higher the price of gold is going to climb. So where else are you going to look for stable wealth preservation than your ounce of gold? And after a debt cap resolution, here's the other thing. There's going to be a very sudden and deep drain on liquidity in our banking system. The U.S. Treasury general account's going to soar. All expectations have it soaring from the current $95 billion, as it's gotten depleted, to $550 billion by the end of June. So in the next month, you're going to see that much money flood into the U.S. Treasury general account. That helps with the blank check writing. And it's disgusting. It's criminal. It's theft for me and for you. And to me, do what the central banks are doing. Buy the gold. And so what if the Federal Reserve pauses on their rate hikes? You know what's happened the last number of times they've done that? In 2000, right after the 2000 pause in rate hikes, gold went up 55%. When they paused in 2006, gold went up 230%. When they paused in 2018, gold went up 70%. So bring on the pause. It's strong for our gold price.
So that's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. If you liked what you heard, do the YouTube button pushing stuff. Or better yet, why not swing on over to our website? We can be found at McIlvaney.com. You can find us on Twitter at ICA Gold or Facebook at McIlvaney Financial. If you'd like to discuss your personal portfolio with one of the advisors here, give us a call. We can be reached at 800-525-9556.
Thanks for listening. Have a great week.